In this video, we'll be watching two accountants deal with the same transaction, which involves revenue recognition. One of them is a really good accountant, and the other is not very good. So we're going to refer to them as the good accountant and the clueless accountant. If you are new to the channel, welcome. My name is Bill Hanna. I'm the financial controller. I'm a licensed CPA in the great state of New York and a controller in New York City. And I share my experience here on this YouTube channel, as well as my website, The Controller Academy, which is a platform where I teach accounting and financial analysis. I'm going to leave a link to it down below. The example we're showing today involves an accounting error and revenue recognition. We will be looking first at the clueless accountant and how they deal with the situation, and then we'll look at the good accountant and how they dealt with that same issue. So, without further ado, let's dive right in. Hey, I was looking at June's financial statements and I noticed something odd with the revenue numbers. Interesting. What do you see? Well, I noticed that revenue went up by about $5 million in June, and the number just doesn't make sense. Can you just check into it? Okay, let me look into it and I'll get back to you. All right, let's take a look here. It looks like this flux is related to one invoice for $6 million that we issued in June of 2024. We signed this new customer agreement in January 24, and they agreed to purchase our website platform services for 3 years, starting in January and ending in December of 2026, for a total of $36 million. They agreed to be invoiced for 6 months for $6 million each. Invoices 6 times $6 million, that's $36 million for the entire contract period. This means that our first invoice to them was in June 30th, 2024 for $6 million. Well, the accounting is simple. I didn't book any revenue and waited until June 30th and issued the invoice, at which point I recorded revenue for $6 million for the month of June. Why on earth is my CFO asking me about the revenue spike? He should know that we invoiced the customer $6 million. I guess I gotta cut him some slack because he didn't major in accounting. I better go and give him a quick accounting lecture. Alright, so you kind of see what's happening here, and if you're enjoying this video and learning from it so far, go ahead and give it a quick like down below. Also, if you've seen what the clueless accountant done and you already caught on what he could have done better, go ahead and pause the video and let me know in the comment section below what did the clueless accountant did wrong and what could he have improved in his performance. Alright, so my own observation so far is that the clueless accountant did two things wrong here. The first one is that he failed to perform a flux analysis on the income statement. If he had done so, he would have been able to catch on the huge income or revenue fluctuation. And the second thing is that he failed to accrue for revenue earned. So clearly the company earned revenue here in the first 5 months of the year, even though they haven't invoiced the client, but they should have accrued for the revenue for each of the 5 months of the year. I'm going to link up here to a video that I made on the various forms of financial statement analysis. I'll leave a link here and down below in the description so you can go ahead and watch it after this video. Alright, so now that we've seen how the clueless accountant dealt with this issue, let's go ahead and see how the good accountant dealt with the same situation. Alright, so let's look into this and let's go ahead and do a flux analysis. This will help me identify large increases or decreases that may indicate the existence of an accounting error. All right, let's see. Whoa, the month of June has a really big spike in revenue. I wonder why this is the case. My next move here is to go over to the accounting software and download a general ledger activity report to show revenue by invoice or by customer. This can help me identify the items causing the big flux in revenue. Okay. All right, here it is. So I see one customer having a massive $6 million invoice. I need to look into the revenue recognition to make sure we recognize revenue in the right period here. Okay, so this is a new customer agreement that covers 3 years of platform services for a total of $36 million over the life of the agreement. I spoke to our service delivery team and they confirmed that we deliver the service ratably, equally, each month over a 36-month period. Now, I need to look at the agreement from the perspective of revenue recognition. The accounting standard for it, of course, is ASC 606. So I'm going to look at the 5 steps to revenue recognition here. The first one is to identify the contract with the customer, which is easy. We already looked at the contract. We have an executed agreement with the customer. Number 2 is identify the performance obligations in the contract. Well, it's pretty clear that the performance obligation that we have is to deliver platform services to them, which we delivered. 3, determine the transaction price. The transaction price is pretty obvious in the agreement. It's $36 million for 3 years of platform services. Step number 4 is to allocate the transaction price to the various performance obligations. And that's also pretty easy in the contract, where you can see that the customer will pay $6 million each 6-month period for the platform services. Step number 5 is to recognize revenue when the entity satisfies a performance obligation. Well, I spoke to my service delivery team, and I confirmed that we delivered the service for the first 5 months and the first 6 months of the year. Each month equally, we delivered one part of the service, so we should be entitled to recognizing revenue. So we should have accrued basically $1 million each month, because we delivered 1 month worth of service for each respective month, regardless of when we issue the invoice to the customer. That doesn't matter. The invoice can be issued anytime. We should still be accruing for revenue. So here are the journal entries that should have been booked, and I will use T accounts to illustrate. All right, so I'm going to set up an account, which is an asset for accrued or unbilled revenue. And I'm going to go ahead and book a debit to this account each month. For January, February, each month, I'm going to book $1 million. And I'm going to record the credit to revenue. So for that same journal entry, I'm going to record debit to the asset, which is unbilled revenue or accrued revenue. And I'm going to be recording a revenue on the credit side in each respective month. Then when the month of June comes around, I'm going to book a accounts receivable or an invoice. So I'm going to issue an invoice to the client, and that's going to be debit to accounts receivable. The credit in that same invoice is going to be to the asset that I had stood up at the beginning of the year, removing or canceling out the debits that I booked in this asset. So now, as of June 30th, 2024, the balance in this asset will be 0, because the debits and the credits will cancel each other out. And all I have recorded so far is monthly revenue of $1 million. And I have an outstanding invoice now for $6 million as of the end of June, which will be paid in the month of July or early August. And that's going to cancel out the accounts receivable that I have here. I'm going to go ahead and repeat this process again for each 6 months period within the 3 years, recording monthly revenue, accruing for the revenue that we earned under the agreement. Also, very important, the proper way to prevent this issue from happening is to have a month-end period close checklist. So in the checklist, you should have a reminder to check for new customers, look at the agreement and see if there is any revenue to be accrued in the period. I'm going to leave a link here and in the description below on a video that I made on how to develop a month-end close checklist. All right, so by now you already know that all the characters in this little skit here is played by yours truly. There are no other actors here. So I hope you enjoyed it, and I hope that you are going to be more like the good accountant. The 2 things to highlight is to develop a month-end close checklist that will highlight the steps that you have to do, the adjusting entries that you have to do at month-end. So that's important as a reminder for yourself when you're closing the financial period. The second thing is to create a flux analysis at the end of the period for the income statement and the balance sheet to highlight accounting errors or irregularities, things that you want to revisit and take a look at. So go ahead and educate yourself via the videos that I'm going to leave in the description below. Also check out the Controller Academy, which is an online course where I flesh out all of these things related to month-end close, financial statement analysis, and all things related to accounting cycle. Thank you for watching, and I'll see you in the next one.